The formidable barrier has crumbled. For countless months, the entire financial establishment insisted that $65 was the absolute limit, the inviolable line. They proclaimed that the banking institutions would defend this boundary with every contractual obligation at their disposal. However, on this Wednesday, the 17th of December, the market rendered its verdict, and it has opted for aggressive assent. We did not merely approach $65, we obliterated it. Earlier today, the valuation of silver surged dramatically, reaching $66.50. As I address you presently, there has been a slight retraction to $65.80. Now, I understand the emotions you might be experiencing. You're observing this pullback, witnessing the price decline from its peak of $66.50 down to $65.80. The specter of fear is undoubtedly creeping in, prompting you to question, was that all there was? Was that the zenith? Is this another deceptive maneuver? I implore you to pause and listen with utmost attention. What we are currently observing is not a collapse nor a failure. It represents the most crucial behavioral pattern a market can demonstrate: a retest. In this in-depth market analysis, we will meticulously dissect the mechanics of this breakthrough. We will elucidate precisely why the price rocketed to $66.50 with such velocity. We will unravel the intricate workings of the gamma squeeze phenomenon that compelled financial institutions to acquire assets against their inclinations. And most significantly, I will demonstrate why this temporary retreat to $65.80 is, in fact, a positive development. Had we continued an uninterrupted upward trajectory, a precipitous fall would have been inevitable. Yet, by receding and validating the newfound support level, we are constructing the foundation for the subsequent ascent. The resistance at $65 has been vanquished, but now we must fortify the remnants. This is the narrative of the breakthrough. To comprehend how silver seemingly materialized from $64 to $66.50 this morning, one must grasp the underlying structure of the market, specifically the concept of gamma. Gamma is a term utilized by options traders, quantifying the rate at which a market maker's risk exposure fluctuates. Envision the market maker as the proprietor of a casino. They sold vast quantities of silver call options, granting buyers the right to purchase silver at a strike price of $65. These options represent wagers on silver's appreciation. As long as silver remained below $65, the house was profitable. As the options expired, worthless. However, the instant silver breached $65, the house began to incur losses, and not minor ones, but exponential ones. At the price of $65.10, the market maker's automated system signaled an urgent threat. To shield the institutions from incurring billions in losses, the systems automatically initiated purchases of silver futures contracts. This buying was not driven by a belief in silver's intrinsic value, but by a necessity to hedge their exposure. Herein lies the paradox. Their hedging activities inadvertently drove the price higher to $65.30, amplifying their risk. Consequently, the automated systems purchased even more, propelling the price to $66. This is the essence of a gamma squeeze, a self-reinforcing feedback loop mirroring the dynamics that propelled GameStop to $400 in 2021. It bears no relation to fundamental economic principles or supply and demand dynamics. It is purely a mathematical consequence this morning that mathematics overwhelmed the financial institutions. The surge to $66.50 was the audible manifestation of algorithms frantically purchasing to mitigate their liabilities. It was a vacuum-driven event, devoid of human sellers, populated only by automated systems desperately seeking to acquire. So, why did the advance halt? Why did we retreat to $65.80? Because human traders intervened. Observing the vertical price trajectory, they elected to secure their profits. The algorithmic buying pressure reached its exhaustion point. Consequently, we have reverted to a more grounded reality, but the damage is done. The $65 level has been decisively breached. The psychological impediment has been shattered, and the market makers are now in a state of apprehension. They are acutely aware that the entity they sought to contain can indeed inflict significant damage. Let us examine the current price of $65.80. To an untrained observer, a decline from $66.50 signifies weakness. To a seasoned professional, it represents validation. There exists a fundamental tenet in technical analysis. Former resistance levels invariably transform into new support levels. For months, $65 served as an impenetrable ceiling, and each attempt to surpass it resulted in a price reversal. It was akin to a concrete roof. Today we have broken through that roof. Now we stand atop it, testing its integrity. This retreat to $65.80 is the market's mechanism for verifying the robustness of the new floor. We need to witness buyers actively engaging at this level. It is imperative that the price remains above $65 for the remainder of the trading day. Such an outcome will affirm the legitimacy of the breakout, signaling to the global market that $65 is no longer a price point for divestment, but rather an opportune entry point. However, I must issue a cautionary note. This is a juncture where prudence is paramount. Should the price recede below $65, and if we close the day at $64, that scenario would be classified as a false breakout, indicating a failure of the upward momentum and continued control by sellers. Typically, a false breakout precipitates a substantial decline. Therefore, $65.80 constitutes a critical battleground, a transitional zone. We possess 80 cents of buffer above the danger threshold. Celebration is premature. We must await the daily closing price to ascertain if the former ceiling can indeed sustain the weight of the current valuation. Recall our discussion of the significant buyer, the mysterious entity that acquired $650 million worth of silver at $63. Many speculated on their whereabouts. Did they liquidate at $66.50? Did they offload their holdings onto retail investors? Having monitored the order book throughout the morning, I can definitively state that this substantial buyer remains active. As the price retracted from $66.50 to $65.80, substantial block orders materialized on the buy side. At $65.75, an entity declared, "I will acquire it." This action conveys a critical insight. Informed capital perceives $65 as an attractive valuation, a sentiment that was previously directed towards $63 just last week. They are now prepared to increase their bids and are actively defending the breakout. This behavior is inconsistent with that of a speculator seeking to exit their position. Speculators divest into strength. This buyer, however, is supporting weakness, establishing a floor beneath the market to prevent a relapse below $65. The rationale is clear. They anticipate what lies ahead. They recognize that if $65 holds, the subsequent price targets are not $66 but $70 and subsequently $85. They are establishing a base camp, securing territory in preparation for the next phase of advancement. Therefore, when you observe $65.80 on your display, do not interpret it as a loss. Perceive it as a consolidation, an opportunity for major players to replenish their resources. The gamma squeeze served as the initial impetus. The retest provides the necessary momentum. However, the ultimate surge, the true conflagration, originates from the short sellers. Large commercial entities such as JP Morgan and Bank of America have maintained short positions in silver for years, strategically selling futures contracts to artificially suppress its price. At $66.50, their incurred losses became catastrophic. In the subsequent segment, we will meticulously examine the capitulation of these banking giants. We will investigate the persistent rumors of a major commercial bank liquidating its short position this very morning. We will elaborate on why the unwinding of short positions acts as rocket fuel for asset appreciation. Furthermore, we will precisely quantify the financial losses sustained by these institutions over the preceding 4 hours. The breakout has occurred, and the subsequent phase of covering their positions under duress is now commencing. Remain engaged for part 2, where we will meticulously tally the bank's losses. For those just joining us, let us briefly recap. We have confirmed a significant breakout. Silver has emphatically surpassed the $65 resistance level, reaching a high of $66.50 and is currently consolidating in the vicinity of this pivotal price point. The gamma squeeze, a frenzied period of algorithmic buying, acted as the initial catalyst. However, a mere spark does not ignite a wildfire. For a blaze to consume an entire forest, fuel is essential. In the silver market, this fuel is not derived from individual investors or renewable energy companies. The crucial element is the commercial short seller. For 4 decades, the bullion banks have engaged in a highly lucrative strategy, selling paper silver when prices are elevated and repurchasing it when prices decline. They function as governors on an engine, regulating the speed to approximately $30 or $50. However, today, that governor malfunctioned when the price breached $65. The financial implications of their position shifted from profitable to disastrous. We are receiving unconfirmed yet persistent intelligence suggesting that a prominent United States commercial bank commenced liquidating its short position earlier this morning. In Part 2, we will thoroughly analyze the bank's capitulation. We will perform the necessary calculations to determine the precise financial losses incurred by the banking cartel when the price reached $66.50. We will expound upon why a bank actively closing its short position represents the most potent bullish force in existence. Additionally, we will investigate why this particular price level of $65.80 represents a threshold of pain that could trigger a systemic margin call. The financial institutions are no longer simply engaging in market competition. They are fighting for their very survival. Let us examine the quantitative data. To comprehend the prevailing sense of urgency in New York, one must consult the Commitment of Traders report. This weekly publication delineates the long and short positions held by various market participants. The commercials, a designation for the bullion banks, historically maintain net short positions, meaning they have sold more paper silver than they have acquired. According to the most recent data available, their aggregate net short exposure stands at approximately 80,000 contracts. Given that each contract represents 5,000 ounces of silver, the total short exposure amounts to 400 million ounces. This signifies 400 million ounces of silver they are obligated to deliver but do not physically possess. Their strategy involves selling this silver on paper, anticipating repurchasing it at a lower price, but they initiated these sales at prices such as $50 and $55. Today, the price stands at $65.80. Consequently, every single one of those contracts is currently operating at a deficit. This situation epitomizes a trap. For a long position holder, the worst-case scenario is a price of zero. For a short seller, however, the risk is theoretically infinite. Should silver ascend to $100 or $500, the bank would be liable for the differential. There is no upper limit to their potential losses. Therefore, at the price of $66.50, risk managers within these institutions were compelled to confront the magnitude of their exposure. Upon reviewing their liabilities and acknowledging the scarcity of physical silver in their vaults, they recognized the potential for losses that could surpass their quarterly earnings. This necessitates a fundamental shift in their operational strategy. Typically, during periods of silver price appreciation, banks would augment their short positions to cap the price increase. However, under the current circumstances, they are constrained from doing so, as their credit lines are fully utilized. Instead of initiating new short positions, they are compelled to liquidate existing ones. The method for closing a short position involves purchasing the asset. This transforms them into involuntary buyers, competing with entities such as Tesla and the aforementioned significant buyer, as well as individual retail investors. At this juncture, the price becomes a secondary concern. The overriding objective is exiting the position. This dynamic generates a substantial surge in demand beneath the market, acting as a trampoline for the price. Every instance of a minor dip is met by a bank stepping in to cover a portion of their contracts. This explains the resilience of the $65.80 level. The banks are in essence consuming their own liabilities. Let us quantify the financial distress. Market movements are frequently driven by the realization of pain, and currently that pain is concentrated within the executive suites of Wall Street. For every $1 increase in the price of silver, the commercial short positions incur a loss of approximately $400 million. Since the breakout commenced around the $60 mark, silver has appreciated by nearly $6. $6 multiplied by $400 million equates to $2.4 billion in losses. In nominal terms, this represents a severe financial setback. The situation is further exacerbated by the fact that this loss calculation assumes they can liquidate their positions at the prevailing market price. However, this is not feasible. If they were to attempt to repurchase 400 million ounces of silver simultaneously, the price would not remain at $65. It would instantaneously surge to $100. This phenomenon is known as slippage. The very act of exiting a trade amplifies its cost. Consequently, the actual loss transcends $2 billion, potentially reaching $10 billion or even $20 billion, a financial black hole on their balance sheets. This is precisely why $65 was designated as the Magno line. Above this valuation, the losses become readily apparent to shareholders, and bank chief executive officers begin receiving inquiries from regulatory bodies concerning their solvency. We are witnessing a slow-motion financial catastrophe. The banks are attempting to extricate themselves with a semblance of order, striving to cover their short positions gradually and discreetly, thereby avoiding any significant price disruption. However, the substantial buyer we discussed in the preceding analysis is actively preventing such an orderly retreat by absorbing available supply. This forces the banks to escalate their bids, driving the price higher. This constitutes the fundamental dynamic of a short squeeze. It is not solely about price appreciation, but rather a transfer of wealth from entities that deliberately suppressed prices to those that facilitated their liberation. Every dollar the price ascends signifies $400 million migrating from Wall Street to Main Street. How can we ascertain the bank's capitulation rather than merely a temporary repositioning for another price suppression attempt? We examine the open interest. Open interest represents the total number of outstanding derivative contracts. In a typical market scenario, when the price rises, open interest also tends to increase. However, during a short squeeze, the price escalates while open interest declines. The reason for this divergence is that short sellers are actively closing their positions and exiting the market. They are withdrawing their participation. Later today, when the exchange releases the preliminary data for Wednesday, we must closely monitor this metric. If we observe the price at $65.80, accompanied by a significant reduction in open interest, this will serve as definitive evidence confirming that the rally was propelled by banks exiting their positions. This constitutes the most auspicious signal imaginable, indicating the departure of the persistent sellers. Once the short positions are fully unwound, who remains to sell? Essentially, no one. The selling pressure dissipates, liberating the price to ascend towards its intrinsic value. However, I must issue a warning. Banks, when cornered, can behave erratically. Prior to their complete surrender, they may resort to a desperate last-ditch effort. They might attempt to unload a substantial volume of paper contracts in the pre-dawn hours, aiming to trigger a panic sell-off. Their objective is to ascertain if they can instill fear one final time. Should we observe a sudden price decline to $64, do not automatically conclude that the rally has terminated. Interpret it as the death throes of the short sellers, their final attempt to generate liquidity to facilitate their exit. Unless the price decisively breaks below $61.50, the established uptrend remains intact. The process of capitulation is a gradual progression, not a singular event. Therefore, the banks are ensnared in a nightmarish scenario of paper liabilities. They are incurring billions in losses and desperately attempting to cover their positions. However, while they engage in their paper-based machinations, the physical reality is rapidly diminishing. The reason for the price surge to $66.50 was not solely attributable to gamma or short covering, but also to genuine industrial urgency. In Part 3, we will shift our focus from Wall Street to Main Street. We will investigate the tangible disconnect between paper valuations and real-world demand. We will examine reports indicating that major industrial consumers are currently offering $70 per ounce simply to secure physical metal. Furthermore, we will explore the dealer market, where premiums are escalating even as the spot price consolidates. The paper market has faltered. The physical market is assuming dominance. Please remain engaged. We need to discuss the $70 enigma. If your sole focus is on the price tickers displayed on financial news channels, you are overlooking the true narrative. You observe the price at $65.80, the flickering red and green candles, and you mistakenly believe this figure represents the intrinsic value of silver. It does not. It represents the value of a paper obligation to deliver silver in New York next month. However, if you disconnect from your screens and engage with the tangible world, if you pick up the telephone and contact a refiner, if you attempt to procure a monster box of silver eagles, you will enter an entirely different reality. In Part 3, we will expose the significant disparity between the spot price and the street price. While financial institutions are striving to maintain the paper price below $66, major industrial users are discreetly paying $70 or more solely to secure deliveries. This is the shadow price, the valuation that entities like Samsung utilize to ensure the continuous operation of their manufacturing facilities. It is the price the United States Mint pays for raw materials and, ultimately, the only price that holds long-term significance. The paper market serves as a distorted reflection, while the physical market represents the actual object. Currently, the object is moving with considerably greater velocity than its reflection. Let us examine the actual cost of silver. Why would an industrial enterprise opt to pay $70 when the screen indicates $65.80? The answer lies in reliability. Imagine you manage a solar panel manufacturing facility. Your assembly line incurs operational costs of $1 million per hour. If your supply of silver paste is depleted, the line halts, resulting in losses of millions. You contact your supplier, who informs you that while silver is available at the ticker price of $65.80, delivery will take 3 weeks. Alternatively, you can pay $70 and they will expedite shipment from their emergency reserve immediately. What course of action would you choose? You would pay the $70, prioritizing the uninterrupted operation of the assembly line over the marginal cost of the metal itself. We are receiving widespread reports of this premium-driven procurement exploding across the supply chain. Electronics manufacturers are bypassing traditional exchanges altogether, directly engaging with mining operations and refineries. They are offering substantial cash incentives to expedite their orders. This activity fosters a clandestine market, with trading volume shifting away from centralized exchanges. This volume does not register on the standard trading volume indicators and does not immediately impact the spot price. However, it is aggressively depleting physical inventory at an alarming rate, while banks are preoccupied with trading paper instruments to manage chart aesthetics. Real silver is being absorbed by industrial consumers at a significantly higher valuation. Eventually, this divergence will necessitate a resolution. When the exchange runs out of deliverable metal, the spot price will be compelled to gap upwards to align with the shadow price. This is the phenomenon that results in silver experiencing a $5 surge within a single trading session. We are currently experiencing this price gap. The screen is disseminating misleading information. The invoice tells the truth. Now let us consider the retail market, the segment where individuals like you and I participate. Visit any major online precious metals dealer at this moment and observe the prevailing premiums. Typically, when the spot price experiences a rapid ascent, premiums tend to compress as dealers aim to liquidate inventory. However, today, the spot price is increasing, and so are the premiums. The reason is twofold. Dealers are apprehensive about their ability to replenish their stock. Yesterday, they sold you a coin for $63. Today, to replace that coin on their shelves, they might be required to pay $65. This leads to a depletion of their capital reserves. Consequently, they widen the price spread, charging you $65 plus a $10 premium, effectively setting the ask price at $75. This strategy is designed to discourage purchases unless absolutely necessary. Alternatively, they may shift to a pre-order model indicating shipments in 4 weeks. What does this signify? It means they currently lack the physical silver. They are accepting your funds today with the hope of acquiring the metal within a month. In essence, you are providing them with an interest-free loan. This represents a precarious situation. If the price were to reach $80 within 2 weeks, the dealer might be compelled to default on your order, refunding your $65 with the explanation that they were unable to source the metal. You would receive your depreciated cash back, but you would have missed the price appreciation. This inventory squeeze at the retail level serves as an early warning indicator, a canary in the coal mine. When dealers cease selling, it signifies that wholesalers have also stopped selling. And when wholesalers cease selling, it indicates that refineries are no longer supplying product. The entire supply chain is experiencing significant impediments. Therefore, if you observe $65.80 on your screen, do not assume you can acquire physical silver at that price. The entry cost for physical ownership is currently approaching $75 or $80. The opportunity for acquiring silver at a discount has effectively vanished. This brings us to the ultimate risk factor, a force majeure. We have discussed industrial buyers willing to pay $70 and dealers charging $80. But what about holders of paper silver, such as ETF investors and holders of unallocated accounts? They possess a contract stipulating an obligation to deliver silver. However, nearly all such contracts contain a clause permitting cash settlement if physical delivery becomes unfeasible due to market disruptions. We are perilously close to triggering this clause. If the shadow price is $70 and the spot price remains at $65, the banks would find it financially advantageous to remit $65 in cash rather than acquiring $70 silver to fulfill their obligation. Defaulting becomes the more economical option. Should a wave of cash settlements commence, it would signify the demise of the paper silver market. This would erode trust, prompting investors to reinvest their cash into the physical market, thereby further inflating premiums. This represents a feedback loop of catastrophic proportions for the fiat currency pricing model. Shortages lead to increased premiums. Increased premiums necessitate cash settlements. Cash settlements trigger panic buying of physical silver. Panic buying then leads to even higher premiums. We are currently in the nascent stages of this cycle. The breakout at $65 served as the initial signal. The inability to procure metal at that price provides the confirmation. If you hold paper silver, you are essentially wagering that the existing system will remain intact. Conversely, if you hold physical silver, you are betting on the system's eventual collapse. Observing the current price spreads, the system is already exhibiting signs of strain. We have the technical indicators, the financial losses incurred by the banks, and the palpable disconnect in the physical market. The mathematical underpinnings favor our position, the geological realities support it, and industry demand is on our side. However, there remains one adversary, your own psyche. The coming days will present a severe psychological trial. Volatility will escalate, news headlines will become increasingly alarming, and the banks will make a final attempt to dislodge you before the price enters triple digits. In Part 4, the concluding segment of this series, I will equip you with the mental fortitude required to navigate this volatile environment. This presentation will outline the anticipated price movements for the remainder of the week and provide a strategy to prevent you from divesting your exceptionally valuable holdings for a trivial sum. The barriers have been dismantled and an unobstructed path lies ahead. Exercise caution to avoid faltering as you approach the ultimate objective. We have arrived at the concluding segment of this market assessment. We have meticulously examined the dynamics of price breakouts. We have quantified the substantial losses incurred by financial institutions. We have unveiled the undisclosed $7 valuation that is presently being borne by the industry. However, it is now imperative to adopt a broader perspective. It is facile to become engrossed in the minute-by-minute fluctuations. It is tempting to fixate on the $65.80 mark, contemplating its immediate stability. Nevertheless, by doing so, you forfeit the opportunity to witness history in the making. Today, Wednesday, the 17th of December, 2025, signifies the conclusion of an epoch. The era of inexpensive silver has unequivocally ended. The period of artificially regulated prices is also over. We have transitioned into an era defined by authentic price discovery. This presents a situation that is both daunting and profoundly invigorating. During periods of price discovery, conventional guidance is absent. Established resistance levels cease to be relevant as we are trading at figures not observed in a considerable duration. The market is currently endeavoring to ascertain a price point that will reconcile a profound physical shortage with a dramatically expanding monetary supply, and I can assure you of this: the price will not be $65, nor will it be $70. It will be many multiples of our current valuation. Within this final analysis, I will equip you with the psychological fortitude essential for navigating the subsequent phase of this progression. I will demonstrate why $65 is, in reality, an economical valuation when adjusted for inflationary pressures, and I will furnish you with the definitive strategy to ensure you do not relinquish your triumphant position. Precisely as the festivities are commencing, the obstacles have been removed and an open horizon awaits. Let us conclude this endeavor. The most significant adversary you currently confront is not a particular financial institution. It is the sensation of vertigo. When an asset's valuation escalates with such rapidity, when it surpasses all previous records and enters uncharted territory, human psychology tends to falter. You observe your portfolio, witnessing a proliferation of gains that historically required years to materialize, now appearing within mere days. Your innate reaction is to question the authenticity of these developments, anticipating an imminent downturn and urging immediate liquidation. Financial entities are cognizant of this tendency and capitalize upon it. They understand that individual investors often possess insufficient fortitude, not due to a lack of capital, but a deficiency in unwavering belief. Consequently, in the forthcoming days, anticipate an intensification of market volatility. It is plausible that silver might depreciate by $3 within an hour, only to surge by $5 in the subsequent hour. This volatility is strategically designed to induce disequilibrium. The objective is to overwhelm you with the magnitude of these fluctuations, prompting a sale simply to regain a sense of peace. Do not concede to this pressure. Embracing volatility is the prerequisite for accumulating generational wealth. If you were to liquidate your holdings at $65.80 now, where would you direct your capital? Would you revert to the dollar, a currency that is steadily diminishing in value by approximately 5% annually? Would you invest in the stock market, which is currently trading at historically elevated valuations? It is crucial to recognize that silver's ascent is not an isolated phenomenon. It is a reflection of the dollar's decline. Silver is merely mirroring the systemic unraveling of fiat currency. Avoid abandoning your life raft to reclaim a berth on a doomed vessel. Disengage from your screen. Cease scrutinizing the minute-by-minute charts. Focus on the weekly and monthly perspectives. The upward trajectory is nearly vertical, and the momentum is formidable. Allow the market to orchestrate the gains. Nevertheless, some assert that $65 represents an excessive price. This sentiment is frequently voiced, stemming from the perception that given silver's valuation a few years prior, its current price point suggests a speculative bubble. Let us examine the historical data. In 1980, the Hunt brothers significantly influenced the silver market, driving its price to $50 per ounce, which represented the all-time peak. However, a dollar in 1980 possessed considerably greater purchasing power than a dollar in 2025. When adjusting that $50 high for the official consumer price index inflation rate, it equates to approximately $170 today. Consider this: to merely match the purchasing power of the 1980 peak, silver must nearly triple its current valuation. At $65, silver is trading at a 60% discount relative to its inflation-adjusted historical high. It stands as the sole asset class globally exhibiting such undervaluation. Equities are at their zenith, real estate has reached unprecedented levels, and art valuations are at an all-time high. Silver, conversely, is still recuperating from a 4-decade bear market. Therefore, when you perceive $65 as an exorbitant price, remember that you are acquiring one of the most undervalued assets in human history. We are not at the market's apex. We are merely beginning to ascend from its nadir. This perspective serves as your protective shield. When media outlets decry a bubble, you can calmly reference the inflationary calculations and remain assured. The actual bubble is not silver, it is the dollar. This brings us to the fundamental question: when should one divest? If the market is indeed heading towards $100 or $170, at what juncture should one realize profits? Herein lies the secret of the affluent. Never liquidate for mere currency. Cash is akin to a melting ice cube. Strategic divestment involves exchanging one asset for another. You relinquish an asset that has become overvalued in favor of one that remains undervalued. Currently, silver is undervalued. At some point, at valuations of $100 or $200, it may become overvalued in relation to other assets. Monitor the gold to silver ratio. Presently, it requires approximately 70 ounces of silver to acquire 1 ounce of gold. Historically, this ratio has averaged between 40 and 50 to 1. In 1980, it reached 17 to 1. Should this ratio decline to 30 to 1, that would serve as your signal. You would then exchange your volatile silver for stable gold, effectively doubling your gold holdings at no cost without ever converting to dollars. Alternatively, you might consider exchanging for real estate. In 1980, one could purchase a median-priced home in America for approximately 800 ounces of silver. Today, at $65 per ounce, approximately 6,000 ounces are required to acquire a similar property. Await the convergence of this ratio. When you can exchange a substantial quantity of silver for a down payment on a farm, that represents your exit strategy. Do not trade for abstract numerical values displayed on a screen. Transact for tangible assets, acres of land, ounces of gold, or income-generating properties. This is the mechanism for solidifying wealth transfer. We have covered extensive ground today, encompassing breakouts, gamma squeezes, institutional losses, the physical deficit, and now the psychological elements. Wednesday, December 17th, 2025 will be recognized as the pivotal turning point. It was the day financial institutions relinquished their grip on control. It was the day the $65 barrier crumbled and the underlying truth became irretrievable. The world now comprehends the scarcity of silver and the historical manipulation of its price, prompting a rush to secure a position. You, however, are already established. You foresaw this development while others remained oblivious. Your task now is straightforward and remain steadfast. Do not liquidate. Allow the market to advance towards you. The surge has only just begun. Persevere with resolve. Subscribe for further insights.